Bitcoin's unique because no amount of capital flowing into a Bitcoin ETF is going to create any more Bitcoin. You know, what we've got is 900 Bitcoin a day. We're going to go to 450 Bitcoin a day. This will be the halving, but it will be the single most consequential halving in the history of Bitcoin, because you're talking about, it's the equivalent of someone coming in the market saying, I'm going to buy $8.5 billion of Bitcoin a year for the next 4 years, guaranteed. That's the demand impact, right? $8.5 billion, $23 million a day at the current price.
Bitcoin maximalist and MicroStrategy CEO, Michael Saylor, is certain that Bitcoin is about to skyrocket to heights never seen before. Recently, Bitcoin had just undergone its fourth ever halving event, reducing the reward paid to miners from 6.25 BTC to 3.125 BTC. Saylor, along with other analysts, believes that this particular halving event will lead to a massive supply shock in Bitcoin. With the Bitcoin ETFs driving the crypto asset's institutional adoption, Saylor foresees a demand shock coinciding with the eventual supply shock from the halving. This combination is expected to create a huge gap between the supply and demand for Bitcoin, boosting its price to insanely high levels. We will now bring you clips of Michael Saylor as he shares his powerful Bitcoin predictions for this cycle.
Ever feel like you're wasting your money on things that don't really matter? Stop. You don't have time. Don't miss out on this 2025 bull run. Educate yourself now. Don't spend $12.50 on junk. Educate yourself on how to be successful in crypto using our crypto cheat guide. Unlock the secrets of crypto and make smarter investments today. Visit the website now on the link in the description for your exclusive copy. Start your journey to crypto success today.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
I'm not surprised they're successful. I expected them to be very successful. I think there's 10 years of pent-up demand. They're the most eagerly anticipated development in Wall Street. This is like Bitcoin coming public. It's like the IPO of Bitcoin, except it's like 10 companies simultaneously taking Bitcoin public. Because Bitcoin's a commodity. It's not a security. So the idea that that BlackRock and Fidelity and Grayscale and Bitwise and ARK, they're all taking Bitcoin public at the same time is a big deal. The fact that I'm not surprised they're successful as ETFs because Bitcoin's the apex ETF. The other ETFs are based on oil, like let's say commodity ones, oil, gold, platinum, silver, palladium, market baskets of commodities, natural gas. All of these things are defective as investment assets because physical commodities aren't scarce. Physical commodities can be manufactured in any amount with additional capital and know-how. So ultimately, the best of them is the gold ETF. But if a bunch of money flows into a commodity ETF, that just actually fuels capital into commodity producers. They just dump that commodity on the market, the price gets held down. So commodity ETFs were never that great an idea. On the other hand, comparing these Bitcoin ETFs to the S&P index, the biggest ETF and maybe the biggest development on Wall Street was the launch of the SPDR, SPY, in 1993, about 30 years ago. And the idea that you could create an ETF that represented a market basket of 500 stocks, that was big. And especially that was big because that came along at a point where people had lost faith in the currency as money, as a savings technology. And so they were trying to figure out what is money. And actually an entire generation of people picked the S&P index as money, right? How are you going to store your excess cash for a decade or longer? Not a checking account, not a savings account, not a bond, but the S&P. So the S&P became money, and that ETF became the monetary index. And that's why today, amongst, that's the most successful ETF. If you look at SPY and all the S&P index type ETFs, they have most of the capital in them. But the problem with those ETFs is that stocks also are not conservative. So if I increase the price of the stock by a factor of 10, you're getting more equity. Or if another way to say it is, if I take hundreds of billions of dollars of cash and I buy the ETF like S&P ETF. The ETF has to buy all 500 stocks pro rata, which means they're going to have to go buy Tesla and Apple and Google and Meta at any price. They're price insensitive, even if they're overpaying. So when they buy it at any price, what they're doing is they're creating more equity because they're encouraging those companies to issue more stock. And then, of course, this is common sense. If the price of your stock doubles, the employees in the company with stock options, they sell the stock, right? They sell the stock option. When they sell the stock option, you put more stock on the market. So the price creates supply. There's a price supply elasticity there. And that's the same as you have with commodities. And it's the same thing with bond funds. When you have capital flows into all those other asset classes, you create supply of that asset. They're not scarce. Bitcoin's unique because no amount of capital flowing into a Bitcoin ETF is going to create any more Bitcoin. You know, what we've got is 900 Bitcoin a day. We're going to go to 450 Bitcoin a day. This will be the halving, but it will be the single most consequential halving in the history of Bitcoin, because you're talking about, it's the equivalent of someone coming in the market saying, I'm going to buy $8.5 billion of Bitcoin a year for the next 4 years, guaranteed. That's the demand impact, right? $8.5 billion, $23 million a day at the current price. Now, that's a huge amount, but more importantly, that's a huge demand supply shift in the year when the demand via the ETFs has jumped by a factor of 4 to 10 times the daily supply. So what you have is institutional capital entering, and then you have the supply getting cut in half.
Meanwhile, analysts at Bitfinex foresee Bitcoin's demand surging to up to 5 times greater than Bitcoin's supply. Since the halving, in a report shared with CoinDesk, analysts at Bitfinex state, with the daily issuance rate declining post-halving, we estimate that the new supply added to the market would amount to approximately 40 to 50 million in USD notional terms based on issuance trends. It is expected that this could possibly drop over time to $30 million per day, including active and dormant supply as well as miner selling, especially as smaller miner operations are forced to shut down shop. With that, let us return to Michael Saylor as he discusses how current market factors will contribute to Bitcoin's exponential rise.
The approval of the ETFs was a pretty concrete endorsement of Bitcoin as an asset class by the regulators. And anybody who's thinking about banning Bitcoin or not approving Bitcoin ETFs, they're now out of consensus. So it really flipped the global consensus from, well, maybe it's too good to be true, maybe it'll be banned, maybe it won't be banned. The approval of those ETFs meant that it doesn't matter who wins the 24 elections. It's taken the future of Bitcoin out of the hands of the president. It's taken it out of the hands of the next head of the SEC. It's taken it out of the hands of most regulators in the world. We pretty much opened Pandora's box or crossed the Rubicon. It's very concrete at this point. And it was uncertain, right, before. And so that's a very big piece of regulatory clarity. What happened next is it's created a positive dynamic where now I think you're seeing pressure to approve ETFs in other places in Asia. You'll probably see Hong Kong spot ETFs. You'll probably see them get approved in any country where people are on the fence. It also created a fee war. It used to be that you paid 2.5%, to hold your money in grayscale. And all of a sudden now you're paying 1.5% at grayscale, but you're paying 25 basis points at BlackRock, or you're paying 20 basis points and even 19 basis points. Not only did that bring down fees for institutional holders of Bitcoin in the US, it also put pressure on international fees. So you actually saw a rippling effect, and people with European or Canadian or other spot ETFs in the rest of the world that had 100 basis point fees or 150 basis point fees, they're having to bring down their fees because otherwise the capital will flow out of their instrument into the lower cost instruments. So Yeah, let me convert the math here. If you have an infinite duration asset and you're going to put if you're going to put money in it, then the difference between 2% fees and 25 basis point fee is losing 37% of your money. You understand? Like it's like I take a third of your money. Okay. So if you're a Bitcoin investor, having low fees means you invest $1 million and you get to keep the $1 million. Having high fees mean you invest $1 million and you lose 300,000 of it over the course of 20 years. So those low fees are, well, where is that going to manifest itself? It's going to drive the price of the asset up, right? First of all, because the people that own the asset aren't losing 1 or 2% of their money every year. But second, because there are a lot of people that they will either invest $1 million in it or nothing, right? So if I like it, I'll just invest $1 million. If I don't like it, I'll invest nothing. So you start to see money flowing from gold into Bitcoin, from real estate into Bitcoin, from the S&P index into Bitcoin. And so that's a big deal. So the launch of the ETFs, it's been very successful. This is the ideal type of asset to put into an ETF wrapper. It's definitely it's the global asset. It's the biggest brand. Everybody knows what it is. It's actually the best thermodynamically sound investment. It's got the best historic performance. And of course, it doesn't have the entire array of risk factors that a company has or that a bond has. It doesn't have credit risk. It doesn't have corporate execution risk, and it doesn't have currency devaluation risk. And it doesn't have the physical risks of real estate. It's not going to ever get hit by a bolt of lightning. There's not going to be a tornado. It doesn't have maintenance decay. It doesn't have property tax risk. It doesn't have the political risk, right? Ask yourself the question, you got $1 billion and you got to buy some real estate in Africa. Where? And where do you want to invest $1 billion in a building? What country? What city? Where? Or you can buy Bitcoin. And of course, so you can see this is a higher quality thing. What was Bitcoin's number one liability coming into 2024? It wasn't the risk. It wasn't the thermodynamic risk factors. It wasn't the technical capabilities. The number one risk factor of Bitcoin coming into 2024 was a government would ban it. But see what just happened in January? The opposite, right? So most of the FUD around Bitcoin is, oh yeah, it's too good to be true. And because it's too good to be true, the government's going to hate that you bought it and they're going to take it away from you. And with the approval of these ETFs, it was the government of the most powerful country in the world, the United States, which is actually the leader of financial regulation. I mean, whatever the U.S. does will influence Singapore, Australia, New Zealand, all of the EU, even Hong Kong, even China for that matter, and all of South America and all the African regulators. So everyone's looking to what happens in the United States. This was a very powerful signal. So that was a bullish development. There was a little bit of weakness following, and I think that's fairly well understood as a couple of factors. First of all, a lot of capital rebalancing. There was capital sitting in the futures, BITO and other Bitcoin futures because institutional investors don't have crypto accounts. They can't trade. And the cost of rolling a Bitcoin position in the futures is like 10%. Imagine you have $1 million and someone charges you $100,000 a year just to have the trade on. Right? I mean, so you could see anybody with that position, they roll out of the futures and they're rolling into the spot. So there's a lot of that. There were some people rebalancing. They had positions in Bitcoin companies and the miners and MicroStrategy, et cetera. And they're rolling out of those trades or rebalancing or arbitraging. There's a lot of people trapped in grayscale and they couldn't get out. And then this unlock allowed some of them to redeem at par. And so there are some people that had 5 years of pent up demand to redeem. And so we worked through that. And then you have the arbitraging between the high fee Grayscale and the lower fee other ETFs. And then finally, you have a lot of Bitcoin tied up in bankruptcy estates, in FTX, in Genesis, maybe, BlockFi, Celsius, Voyager, Three Arrows, Genesis, FTX, Alameda. Well, all of those estates are controlled by lawyers. And the lawyers aren't they're not hedge fund managers. They're not even 10-year investors, right? The lawyers have legal and process constraints. And maybe what they want to do is just wind down the trust, pay out the trustees, or the creditors, declare a victory and move on, right?
Do you agree with Michael Saylor's perspectives? Share your thoughts in the comments section below. If you enjoyed this video and found it insightful, consider giving this video a like, subscribing to the channel, and turning on post notifications to stay updated with our latest content on crypto news. Your support encourages us to keep making more videos to help everyone stay on track with relevant news, guiding them on their crypto journeys. Thank you for watching. We hope to see you in our next video. For more Daily Dose Crypto News, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.